The tremors that once shook the financial world are far from mere echoes of the past, as the banking industry receives a stark reminder of its ongoing challenges. The air around regional bank stocks grew heavy on Tuesday, weighed down by the somber news that Moody's Investors Service had downgraded 10 mid-sized institutions. Among these, the likes of M&T Bank, Webster Financial, BOK Financial, Old National Bancorp, and Fulton Financial Corp. all suffered a single-notch blow. A looming question emerges: are the hardships faced by these banks a portent of more to come? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The echoes of financial turmoil resounded anew as the banking industry navigated a fresh set of challenges. Mid-sized institutions, which were recently hit by a downgrade from Moody's Investors Service, found themselves under scrutiny once more. M&T Bank, Webster Financial, BOK Financial, Old National Bancorp, and Fulton Financial Corp household names were among the 10 casualties of this downward shift. But this was not the end. 6 other banks, including the notable U.S. Bancorp, Truist, State Street, and Bank of New York Mellon, teetered on the edge of possible downgrades. Furthermore, a negative outlook was cast upon PNC Citizens Financial, Fifth Third, and 8 additional banks, casting a shadow over their financial futures. The repercussions of this event were far-reaching, causing a ripple effect that led to stock declines exceeding 1% for many of these institutions. This market quiver was mirrored in the KBW Nasdaq Bank Index and the SPDRS and P Regional Banking ETF, both of which saw more than a 1% decline. Moody's decision to lower ratings was attributed to a web of pressures that had entangled mid-sized financial entities nationwide. Factors ranging from escalated deposit costs and dwindling profitability to heightened capital requisites and a slump in commercial real estate all played a part in this disheartening downgrade. A central catalyst in this financial choreography was the Federal Reserve's zealous endeavor to rein in inflation through heightened interest rates. The campaign's significant impact on the funding and economic capital of the U.S. banking system prompted Moody's to take action. Although this move might appear retrospective, J.P. Morgan U.S. equity strategist Abby Yoder urged a broader perspective. She likened it to a rearview mirror glance at the sector, suggesting that the sector's recent rally may have contributed to the stock drop. However, the aftermath of this event disclosed a more nuanced reality. While second quarter earnings seemed to dispel lingering anxieties of a replay of the spring's financial disturbances, a troublesome trend emerged. Many regional banks saw their deposits surge during the quarter, albeit at the expense of offering higher interest rates to attract these deposits. This, in turn, took a toll on a critical measure of profitability. For institutions like PNC and Truist, this prompted a recalibration of revenue and lending profit expectations for the year ahead. Even Fifth Third adjusted its course, revising its full-year forecast range for net interest income, an indicator of the disparity between loan earnings and deposit costs. Amid these shifts, Fifth Third's chief executive, Tim Spence, stated that prudent planning for conservative outcomes was their approach, enabling stability in earnings. As the sector grappled with this fresh bout of volatility, regulators such as the Federal Reserve, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency seized the opportunity to advocate for new capital standards for banks. They argued that these alterations were indispensable to fortify lenders, bolster resilience, and enhance preparedness for crises. Unsurprisingly, this overhaul faced resistance from the banking realm, asserting that today's institutions are more robust compared to the 2008-9 financial crisis era. The potential imposition of higher requirements raised concerns about lending restrictions. In the midst of this turbulence, mid-sized banks began to adapt. Some refrained from increasing dividends or share buybacks, while others offloaded assets to minimize balance sheet risks or reevaluated certain lending practices. Acknowledging these actions, JP Morgan equity strategist Abby Yoder commended these endeavors, considering them in line with the reconstruction of balance sheets ahead of looming regulatory alterations. While banks might witness a dent in profitability, Yoder suggested that in the long term, this pursuit would leave them in a more resilient state. In a world where the financial realm seems to continuously ride waves of uncertainty, how do you view the delicate balance between regulatory safeguarding and the potential limitations it places on lending and economic growth? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.